All right, well, hello, and thank you for attending today's webinar on Maximize Your Exit Later by Planning for It Today. Today's webinar will enable you to identify your level of readiness for a successful exit, list the steps in the exit planning process, and compare strategies to grow before, during, and after transition. Now, this webinar is the first in a series of quarterly webinars about the challenges, solutions, and process of an exit, so stay tuned for more content like this, as well as other valuable resources on this topic in the coming months. Now, we know organizations must keep up with change. So today, through the lens of maximize your exit later by planning for it today, we're going to be focused on navigating disruption, empowering operations and digital transformation, which will help you stay informed and up to date with today's marketplace demands. And before I pass it off to our presenter, I have a few tips on using the Zoom platform so you can engage with our presenters and have the best experience possible. You should see the following icons on your Zoom toolbar: ask a question, chat, and raise your hand. You can use the ask a question or chat to submit a question at any time or comment. If you need any assistance, click on the raise hand and I will connect with you as soon as I can. We do encourage you to ask questions throughout the entire presentation, and we will address the questions towards the end of the webinar. If you experience audio issues, you can access your audio settings and test your audio when you are already in the meeting. At the bottom left-hand corner of the Zoom meeting toolbar, you'll find either the headphone or microphone logo to join audio. Click Join Audio to choose to connect your computer audio or dial into the meeting with a phone. Today's webinar does qualify for CPE credits, so in order to qualify, you do need to respond to all the polling questions and stay on for the entire duration of the webinar. If you have any technical difficulties answering the polling questions, please email elevatelearn@armaninollp.com with your name, date, and name of the webinar, along with your responses to the polling questions. And with that, I'll hand things off to our presenter as we explore today's topic: maximize your exit later by planning for it today. Bryan?
Thanks, Jonah. Welcome everybody to this kickoff meeting, to this first in a series of at least 9 different topics that we're going to be exploring. I'm really excited to be here. I think we have over 500 business owners that have signed up for this seminar today, and I wanted to share with you some of the inspiration behind this, as well as my background. So I've been running the transaction practice for almost 10 years. Our firm typically does about 200 transactions a year. Prior to coming back into the consulting world, I spent 17 years in corporate, in public companies and private equity owned companies. I was involved in 14 acquisitions and actually 3 sale processes. And then coming back to public accounting in the consulting world, as I said, I've been running the transaction practice for almost 10 years. And undoubtedly, so many clients come to us with an LOI in hand, asking if they should sign it, or worse, with the purchase agreement, asking for a couple of quick questions that they want done before they sell the company and basically get the biggest liquidity event of their life transpire to them. And I got to thinking, there's so many things that we can do to help our clients if they spend more time on the planning side, preparing for the exit years in advance, before they get approached with those LOIs or purchase agreements. They'll be so much more prepared, and we can help maximize the value for their businesses. As I look over the landscape at the demographics, what's going on in the world, in 2000, there were statistics that said 7 out of 10 businesses are going to go through a liquidity, succession, exit planning process. The majority of those are going to be a complete exit to a different company. In many cases, it's going to be to a private equity firm. And so as I also lead up the private equity industry for the firm, I know a lot of private equity firms. I used to work in the portfolio company of a private equity firm. I know what they look for. And with the prices that they're paying for businesses, they're spending a lot on due diligence. as well they should. And there's a lot of lessons learned that we put into this educational series to help prepare you for what to expect when you get to that exit time and the due diligence phases to prepare you to be able to maximize your value. So as I go through this, feel free to send questions in the chat. Jonah and Travis will help us monitor those, keep us on track. Hopefully you'll find this just basically a nice overview for what's about to come. There may be some insights in here that I'll share, but in most cases, it's a fairly high level overview of various phases and issues to be planning for as you start to prepare for the exit, to give you an overview of how much work is involved and all the things that you can be doing in advance to prepare for that ultimate day when you want to maximize your value and enjoy the success of all your work that you've spent your whole career, your whole life, potentially many generations of your family building the wealth to be able to enjoy for future generations. So again, we're going to talk a little bit about the current state of exit readiness, increasing the value of your business, preparing for the exit, and then a brief overview on some of the tax implications that can come from an exit. But first, I'll turn it over to the polling questions so we can keep on track with those.
This is everyone's favorite part, Brian. It's the polling questions that everyone has to do for CPE, but nobody wants to do. All right. Get that launched here.
There we go.
Definitely some interesting results coming in here. I'll give it a few more seconds. Make sure everyone has a chance to respond. All right, looks like everybody has answered. All right, so Brian, what do you think about this here? Looks like 64%, the vast majority of the group said no, they do not have a plan for an exit.
Well, it's not surprising. It'll actually be a good segue when we get into the section about planning for an exit. It's unfortunate though, because there's so much that can be done in advance to prepare for an exit. So I think it does set the stage for this series of webinars and email educational topics that we're going to be covering over the course of the next 6 to 9 months. So I wanted to share a little bit of M&A activity here for our viewers. As you can see, M&A activity always remains fairly strong. However, in 2021, we saw a tsunami of activity driven by two things. In 2020, most businesses were dealing with COVID, and businesses that were having issues, were not moving forward with transactions in a lot of cases. And then there was also the threat or the discussion on the tax laws that might be changing that could impact the taxes paid on business transactions. And so there was a lot of effort to try to go through an exit process in 2021. However, as you see in this data, through just 6 months of the year, we're on track again to have high transaction levels for 2022 compared to 2021. And a lot of statistics that I see and research out there still indicates that a lot of business owners, again, in kind of those higher or older demographics who have been through the 08, 09 recession, went through the pandemic, there's a lot of desire to try to get the most value for the businesses today. And businesses that did well in the pandemic, are seeing very good pricing coming out of it. This data doesn't reflect some of the increases in the interest rates that have been taking place and supposedly the softening of the economy towards a potential recession. You keep hearing the R word out there a lot, but every indication that I see in the M&A world, there's so much abundance of capital out there with private equity firms. Family offices have played a big role in changing the M&A dynamics. And then you also had the SPAC situation over the last couple of years where companies raised capital just for the purpose of doing acquisitions. So there's a lot of acquisition dollars out there on the sidelines, plus all the strategic companies that are also looking to diversify and continue to grow via acquisitions. So we expect the transaction pace to continue, which is good for business owners that are looking for an exit. A couple other things, I mean, by sector, everything still seems to be pretty good. We've seen a bit of a tick up in IT and technology related companies. I think the pandemic exacerbated that and really emphasized the need to have technology out there. So there's a lot of companies that have been taking advantage of the opportunity to go through an exit that owned technology, service related type businesses. But overall, it's kind of a good mix again, and just really, I think, still sends a positive light that there's opportunities for business owners to still get a good value for their business, despite all the headwinds and other things going on in the economy. So this kind of goes to the polling question here. A couple of things as we go into this, I wanted to kind of share with you. In most cases, the ideal allocation of your assets should be diversified. But with a lot of business owners, this basically says 80% of their wealth is tied up in the business. And in some cases, the business might not be generating strong cash flows, but the value of that business is significant, and it makes up the greatest proportion of the asset value for the business owner, their family, and their future generations. One of the statistics too, and I didn't mention this in the prelude, that also I wanted to point out, and the reason to plan, is that nearly 80% of businesses that go through starting a sale process do not end up selling. That's a little higher than I had thought. I thought the number was closer to 70%. I had attended a seminar a couple of years ago with a PE firm that does hundreds of transactions a year, and they did a 5-year study of all the CIMs that they had reviewed to determine which ones actually sold, and they said they could only find about 30% of the companies that they bid on or viewed, researched, that actually went through a sale process. So there's a lot of reasons why companies don't sell. We'll cover some of those in here. A lot of them is because the planning wasn't done in advance and things fell apart as the process started. There's some other statistics on here about business owners that regretted selling their business. And, in some cases, there could be other factors that are tied in, and loose ends and earnouts and things that could cause the business owner to not be happy afterwards. And then it also says, for businesses that are thinking about a succession plan, there's a lot of information in here that can be applied to a succession transition, just like if you were doing to a third-party exit transition. So even if you're only planning on keeping the business in the family, there's things in here that can really help you prepare for that. So again, this kind of talks to it. I mean, 79% of owners have no written transition plan, and 48% have done no planning at all. I think our polling said that over 60% of the people on this call have not done any planning. So again, just the need to emphasize how important it is to have a transition strategy, whether it's for your family or for a third party. Just having a plan will help you be more prepared. And I've heard this said before. I mean, you really only have two choices. You can plan for your exit or not plan, but eventually you are going to exit. And so, this is designed to help you think about the planning steps to prepare for the process and be prepared for when that time somebody does come and make an offer to you that you're comfortable with and they're the right fit, or it's for your family. It's just trying to all the things that can be done. That's what this series is designed to help you with. So it's not a simple process preparing to sell your business. Many of you probably have sold houses that you've lived in before or cars that you've owned. There's some similarities, but just as if you were going to sell a car, you would take the time to wash it and prepare it and clean it out. A house, same way, you clean it to try to get the most value for it. And that's kind of what you would do with the business. There's so many different things that you can do to prepare your business to maximize the value and go through the process, along with things that we're going to point out during this seminar that can prevent the process from derailing. So as I mentioned, 80% earlier, 80% of the transactions don't go through to a successful sale. And a lot of it is because the planning wasn't done in advance. The offer dollars might be great. The company that's looking to acquire the business might be a great cultural fit, but in the end, things can derail the process. And this seminar is designed to try to help go through that process, not just to maximize the value, but also help get through the process, streamline the process when you get into that due diligence phase. Okay, so there's two questions that come up a lot: is how much is my business worth? And then that's compared to really how much will someone pay for my business? Those are two different questions. You don't get the same answer for those two questions. And we're going to dig into that a little bit here next, right after we do another polling question.
Yeah, speaking of selling your business, so how confident are you that the valuation of your business would be fair? Very confident, somewhat confident, not at all, or not applicable? No idea what we're even talking about. Again, I'll give everyone a few minutes here to submit their questions, or a few seconds. Very interesting results again. Looks like so far, let's see here, everyone's getting in the somewhat category for the most part here. And don't forget, everyone, please be sure to put your answers in the pop-up window for the polling questions. All right, let's take a look at these results here. So 65% in that somewhat category, Brian.
Okay, that's interesting data, which is not surprising, and that's why I set up the previous slide here. If I back up just one, about how much is my business worth versus how much will someone pay for my business, because in the end, your business is only worth what somebody's willing to pay for it. And so we'll go through some of the valuation exercises that can be done to help you get a better idea of what your business could potentially sell for, which is different than what it could be, what it might be worth. Difference between an appraisal, I guess, and what a real estate agent might tell you they think your business could sell for, if like they do when they're looking at houses. And a lot of this is just good to get started with, is to get a good idea of how would a valuation expert look at the business cash flows that generate the ultimate business value. And we're going to talk a lot about cash financial statements later on in this overview, but basically having a good valuation started at the beginning can also help set the groundwork as you're working through a 3 to 5 year plan to maximize the value, because you'd like to know how are you doing towards that value. And so evaluation takes into account a lot of factors, but in the end, it's still a theoretical indication of value that can just be used until the time you actually really get offers on the business and the ultimate sale price. We'll just give kind of a high level overview of what's all involved in estimating the value. Typically, A firm will look at 3 months financial statements, ask questions about the operations, do industry and economic research, especially if it's a niche type industry, trying to understand how are other companies in that industry selling for. We use real transaction data when we're putting together an indication of value. And we spend a lot of time, again, trying to get to a good EBITDA cash normalization of earnings value to be able to use to value the company. We also look for what I call value drivers and value eroders. So there are certainly things that can drive up the value in certain industries and for certain companies, and there's other things that can really detract from the value that we take into account. And because we do so much transaction work, our valuation people also understand, what could erode the value from a real transaction perspective versus just doing a theoretical indication of value. So again, as I said, we have a lot of competitive value benchmarks. We look for potential valuation and growth potential, and we're always looking at real transaction data to help assess the best indication of value for you as you start the process of preparing to maximize the value. Certain things like looking at the growth factors in revenue, the growth factors in EBITDA. Most businesses, are going to trade on a multiple of EBITDA, and or a potential multiple of revenue could drive if you're more of a services or transaction type business, and depending on the buyer and the synergies that they bring to the table. But it's obviously a business that's growing, both the top line and the bottom line is going to have a higher value than a business that's stagnant and not growing. So here's where I was talking about value drivers. Lots of different factors, some tangible and some intangible, can drive the value of the business. Competent autonomous management teams, good long-term customer contracts, key employees, the proven track record of revenue and profit growth, good clean books, operations are in good shape. Lots of things can really help drive the value up. Other things that we try to look at is, comparative benchmarks against other companies in the industry. Sometimes this is difficult to find. We have lots of research databases that we can try to do some common size analysis. As I said, we do over 200 transactions a year, so we might have worked on a transaction in a niche industry that we've got some real intel on that we obviously can't share confidential information, but it can help us as we're doing benchmarking statistics. But with all the research, the data that's out there that we have access to, we're usually able to provide a pretty good idea of, is your revenue, is your margin, is your operating expenses kind of in line with other companies in your industry or that we see going through processes. And here's what I was talking about is a lot of times, the value of the business, indication of value, a lot of buyers, a lot of PE firms, a lot of investment bankers are basically providing you an estimate based on a multiple of your EBITDA or your revenue and or both to come up with what they think an indication of value is. Our valuation team gets a little bit more into the weeds with discounted cash flow analysis, using different types of benchmarks and data that we're able to get that sometimes maybe an investment banker doesn't have access to, or a PE firm might just know the industry and know that it's going to trade for a multiple of EBITDA of X, and that's what they kind of throw out there when they reach out to business owners. And being in corporate for 17 years and also now dealing with business owners all the time, I know many of you are getting hit on multiple times a week from various PE firms that are out there, family offices that are out there looking to buy businesses, and synergistic buyers. But the PE firm world, they're hiring business development people, and that's their job, is to be on the phone and be on the emails, researching companies, and basically trying to get anybody to take their call and have a conversation about potentially buying their business. So again, as we go through the process, trying to look at what the current value is, the goal is to identify things that can add value to the company and start to put a plan together to kind of drive that value up and maximize it over time as we prepare for the sale process. So this next section, we're going to talk about some of those things. On the valuation, we take some of those things into account, but there's definitely things that can be done to improve the value of your business prior to selling the business. A lot of them are operational in focus. So lean processes, improving processes, things that you can do to improve earnings and enable growth, to scale the business, or to demonstrate that the business can continue to make improvements for a buyer or an investor, or even for the next generation, are very important. So the lean processes, operational improvement consultants that can come in, study a process and figure out ways to improve those processes are really important. And those things usually are not going to be done overnight. They take time to work through. But with a good plan and a good process improvement team focused on how can we improve our processes to reduce waste and increase our overall margins, are going to be very important, or just to increase throughput. If throughput is a challenge to be able to drive more sales, you've got to be able to figure out how to do those things. And some of it could come from outsourcing certain processes, as well as just improving the processes. Also, going through this planning phase, there's certain operational diligence that can be done to prepare for the diligence that's going to come from a potential buyer. So many things can be done to maximize value by improving the processes, but also our team that gets involved in this, they're seeing, issues when they go in and a client of ours has done an acquisition, trying to figure out how do we maximize that acquisition in a post-merger integration plan. A lot of times we're brought in by PE firms who basically say, we bought a company that does a 10x or $10 million of EBITDA, and we need to sell it for $20 million of EBITDA in 5 years. And so that we put plans together to how are we going to increase the EBITDA to maximize the value for an exit. And it's the same concept in preparing for the sale process, is kind of going through all the different activities of the processes to figure out, where's their meat on the bone that we can look to try to improve processes, reduce labor costs, improve throughput capacity, all the different things that maybe a business owner is content with when the business is doing well. But to prepare for the sale process, there's things to do to tighten things up and improve the processes and demonstrate that there's more opportunity for a new buyer down the road to get some value out of the operational processes that are in place. Other things such as system improvements, using upgrading the ERP system, the financial reporting systems. There's so many different things that need to be looked at on the operational side of the business, besides just on the financial statement side, which we'll talk about in a little bit. Not to mention, taking a look at the business risks, talking about growth opportunities. Even if you're just looking to potentially recapitalize the business, or maybe take a little bit of money off the table, but you've got some great ideas on how to grow the business, and you're looking for a partner to come in and provide some capital with less risk to you, trying to help frame out those growth opportunities and model out how well the business could do if you invested in a new growth or revenue stream. And again, looking at, as everyone's probably dealing with, a lot of inventory and supply chain challenges that are going on out there in the marketplace. So we're going to start moving from a little bit of operations now to the people side. And A lot of times in privately owned businesses, there's some challenges with uh, going through a sale process. There could be family members on the team. There could be family members not on the team, but on the payroll. There could be just long-term employees that the business has not addressed certain performance issues. There's a lot of opportunity to start to go through and look at kind of the human capital strategy of the company and prepare for the sale process to maximize the value again for a potential buyer. Oh, I was going to say, so this slide's taking a little bit longer to kind of develop, but kind of going through and doing a leadership assessment. And as this slide's kind of finishing, I guess I've learned a lot from our private equity clients that there's usually two key things that they focus on that attracts them towards doing an acquisition. And usually it's a brand that the company has, whether it's a tarnished brand or a well-respected brand. It's at least a brand that they know they can capitalize on. Then the second thing that they say is the most important thing and the fastest thing they need to get their arms around is the leadership team. And so as I've been working with our strategy and transformation group, we've been focusing on how can we help clients prepare for the type of diligence assessment that a buyer is going to come in and look at in their leadership team. And I've seen transactions fail where the owner was the entire brand of the business and had not done a good job developing a strong leadership team underneath themselves. And that can come out during the diligence process based on the questions that come up. But if you have a desire to retire and go to the beach and you haven't developed a team that can take your place, that's going to cause some challenges going through a sale process. And I've seen that too many times. I've been on the buy side before where the owner says they've got a leadership team, but as we go through the diligence and we ask questions, we realize the owner is answering every question, which is a telltale sign that maybe the leadership team is not strong enough to take over for the owner if they were to walk away. And in those kind of situations, a lot of times the owner is not allowed to walk away. They're tied up with some type of contingency or earn-out plan to guarantee that the business will continue to do well through the post-transition days as the owner is trying to step back away from the business. So there's a lot of things that can be done on the leadership side and the human capital side to prepare the business for a more successful exit. So some of the things we look for, understand the company, team, individual goals, just because we've identified, challenges with the leadership team, there's coaching and opportunities to continue to develop that leadership team for a potential or ultimate exit process where they'll be able to stand on their own and do a great job after the owner has moved on. And again, there's ways to measure that, make sure we've done cultural assessments on the leadership team. Are they going to be a good fit for a new owner? What are the risks for that leadership team? Because if they end up leaving before the transaction happens, that can erode the value as well. And for those business owners that are sitting there on this call thinking, I don't really have a strong leadership team, all the things Bryan's been saying is right. I do everything. I wear the finance hat, the sales hat, the operations hat. Starting to make the investment today to develop that leadership team could add a lot of value down the road. And so there's just so many different things to look for. And, it's not easy to go in and bring in a chief operating officer or a new CFO right before a transaction. There's a lot of dynamics to take into account. And also to think through, when you're going through the hiring process with somebody at this level, Do you share with them that you're thinking about an exit, that they're the succession? What's the incentives in place for that person to stick around and go through the process? It's not for everybody. And so there's a lot of effort that needs to go into that, into building a leadership team if you don't already have it. And then if you do have a leadership team, assessing potential weak links or issues that a potential leader on that team might have with a private equity buyer, a synergistic buyer where maybe one of your top leaders came from a competitor. Could there be issues there? All kinds of things to think through as you're preparing, again, to go through this process. And then that leads to the whole marketing efforts. A lot of those valuation slides I showed earlier basically said the more a company can show or demonstrate a strong growth history on the top line with the potential for future growth history, this is going to just maximize the value. And a lot of companies have not really developed a marketing strategy to support the growth strategies. And when times are good, all marketing seems to work. But putting together a good marketing strategy to grow the business, both before the transaction, have it set up to where as you're going through the process, which a process can take 6 to 12 months sometimes to make sure that the business continues to do well. And then something that sometimes business owners don't think about is a lot of times there's contingent earnouts and other value that can be derived with a second bite of the apple after the transition. So it's an area that you want to continue to invest in and make sure that you're doing all the right things to grow that brand, which I said is what a lot of companies look for, and continue to be able to grow the company throughout the transition and beyond. There's also, we're going to talk a little bit about some of these other items here about the communication strategies. As I said, when you've got a leadership team, when you bring that leadership team into the fold, under the tent, when do you talk to your clients, when do you talk to your customers? Basically, that kind of rolls right into this next slide, which is the strategic communications, both with internal and external stakeholders, is critical. That comes up almost every private company transaction or transition that we work with. The owner is scared to death that their people, their customers, even their vendors could find out about the transaction. And so, as you communicate, this is so important to have a communication plan in place to communicate to all the stakeholders throughout the process before you start the process. So we're going to talk a little bit about financials next, but before we do that, got to move into a polling question.
All right, so polling question number 3, what part of planning for the sale of your business are you most anxious about? Option A, preparing financial statements, B, internal communication, C, something else, or D, not applicable. We'll give it a few more seconds here and then we'll share the results. Okay, so Bryan, it looks like half the group are concerned about something else.
I put that in there for a reason, because I just picked on 2 things that are in this presentation. And we talked about a number of other things that might get people thinking that there's something else that's more important, which would be interesting to understand what some of those things are. So if people are open enough to share that in the chat, that would be great to know as we go forward. But this next section, we just talked about internal communication. I'm going to talk about preparing the financial statements. It's amazing how many times I get approached about what is a quality of earning? I get asked the question, what is a quality of earnings, and why do I need to do that when I already have an audit, or I've got a great tax accountant who does my tax returns, and I got approached and asked just to provide my tax returns, and the buyer or whoever you're talking to says they can give me a good indication of value just off of my internal QuickBooks financials, or if I give them my audited financials. And I'm not sure there's ever a level other than a public company that has a publicly traded stock value where it doesn't pay more than the cost of preparing what's called the quality of earnings, to prepare more seller-ready financial statements to go through a process. An audit is focused on net income, and it's great to have an audit. Shows that you've got good controls in place, or a review, same way. Generally, the financials are in accordance with generally accepted accounting principles. And a tax return is many times designed to lower your taxes, which says lower your net income in some ways, by looking for ways to utilize the tax laws to lower your taxable income. And a quality of earnings, which we'll get into later, is a different way of putting together the financials that is used in a lot of cases, as I talked about in the valuation section, to come up with a multiple of your EBITDA. We'll talk about that going forward, but a couple of other reasons to do this is, in some cases, a privately owned business, may not have generally accepted accounting principle financial statements, might do a lot of financial statements on a cash basis, which is fine to lower taxes, expense things earlier, and basically could just have poor financial statements. And I put in here at the end, and I'd make this comment a lot, having good quality financial statements won't necessarily increase the value of your business, but I've definitely seen where poor quality financial statements can not only negatively impact the value of the business, but also increase the risk the sale doesn't go through. I mean, I've seen situations where I've been on the buy side and the sell side where the financials were in such bad shape that the transactions just couldn't go through because the financials couldn't be relied upon. And so in some cases, there's a lot of work to do to start preparing the financials for a sale process, to make sure that when the buy side diligence team comes in, everything's prepared, ready to go, and presented in a seller ready presentation, which is different than just having an audit or a tax return provided to them. So, I mean, who needs to prepare seller ready financial statements? Basically everybody. Whether you've got great GAAP financial statements, great detail account reconciliations, you name it, everyone should prepare for a sale process. What I've seen happen over the last 10 years is the buyers would pay somebody to come in and do a quality of earnings, and the sellers were not doing that. They weren't preparing for the buy side diligence by doing a sell side quality of earnings. And over the last 3 or 4 years, the companies that have gone out and gotten professional services, whether they're using an investment banker or an investment broker, or they've got good legal and accounting representation, they've all recognized that it makes sense to prepare for the sale process for what the buyer's due diligence team is going to look for by preparing a sell side quality of earnings analysis to kind of identify issues that the buy side might come up with on the financial side. Because once you get down the steps of the financial due diligence process starting, basically almost any item that's found, dollar for dollar times the multiple, can come off the value of your business. And I always like to tell people, when you sign the LOI, that's usually going to be the maximum value you're going to see. When the due diligence starts and financial statement issues or financial issues start to come up from the due diligence, a lot of times those are going to lower the value of your business if they're negative. if for some reason you find positive items, those are harder to get additional value from. I have seen it though, where a business signs a great new contract right before the sale, and there's ways to negotiate more value into the business. But more times than not, usually the buy side team is getting paid a lot of money to find issues and point them out to their clients. And then those items are used as negotiation tactics to try to lower the value after the LOI has been signed. So again, this is just kind of talking about, all the things to start to do to get ready and prepare for the financial diligence. There's a lot of numbers on this slide, but I talked about this term quality of earnings for anyone who's not familiar with it. Basically, this is what a presentation of a seller-ready financial statements looks like. It's basically starting with your revenue, but then it's getting to these adjustments that are identified during the process. And it gets down to basically a diligence adjusted EBITDA number, which is what's being used to really put a value on the business for the buyer that's coming in and willing to pay a certain multiple for what are the normalized earnings of the business. Lots of different ways of doing this. Lots of data analytics goes into identifying variance questions and questions about certain accounts as to why they changed. It's a very detailed review, somewhat like an audit, but different than an audit because it's trying to get what is the real true cash impact of a transaction that happened in the current year, current month, and the periods being used to come up with the value for the business. This just kind of talks about some of those items. It's looking for non-operating items, non-recurring or unusual items, errors, refunds, adjustments, out of period adjustments, things that happen to the business that, in the ordinary course of doing the accounting, just kind of happens. They get expensed, they get recorded. Finance teams, accounting teams are not thinking of how am I going to prepare a sale ready presentation, 2 years from now. It's basically just doing everything to keep up with the accounting, making the best judgment possible to record the accounting as they deem fit. And then, that's why it takes a professional team to come in and really pull all these items out, asking questions to the finance team. One other thing that's really critical to point out that sometimes doesn't get looked at in the course of the financial due diligence and transaction until the very end is net working capital. It's a factor on the valuation of the business. It's usually kind of carved out and separate that the seller needs to leave enough working capital in the business for the buyer to be able to run the business based on the value of the business. And so many times, both the sell side, their investment bankers, they haven't thought through the significance of this net working capital and how at the very end, the buyer could come back challenging the working capital number that's in the business for whatever reasons, whether the owner took cash out of the business right before the sale, some clients didn't pay, customers didn't pay, or they paid a lot in advance right before the sale, inventory buildup, working capital needs to be taken into account. Payables could be some bad debt on the receivable side. There could be some payables that have been extended. All those things have to be taken into account as you go through a sale process. So our final section is going to move into tax implications of an exit. But before we do that, we've got to have our final polling question.
This is the part where everyone does a little dance, and then while the polling question's going, we'll have to try to get some Jeopardy music or something playing next time around. But so polling question, final one. Would you like to connect with someone from Armanino regarding preparing for an exit? Yes, no, not applicable. I'll also take this little moment here to plug Bryan. If you want to connect with him on LinkedIn or follow him, I'll drop a link to his profile in the chat for you. So no pressure, Bryan.
Thanks, Jonah.
All right. All right, Bryan, we can go to the next one there.
Okay. All right. Before we go on to this next section, and it won't take much longer, because I'm going to preface it by saying I am not a tax expert by any means, but sometimes I do play a tax expert on panels. And usually my role on those panels is, as somebody who's run the transaction practice for 10 years, what is one of the biggest things that can cause a transaction to fail? And in many times what I have experienced is it's because the tax planning was not done in advance to prepare the company for the sale process, whether it's the structuring of the company or just tax issues that had not been addressed, that were perfectly fine during the tax return process and the compliance part of running the business, but is different as you go through a transaction and a change of ownership. The exit option analysis is, there's so many different types of transactions that can take place. And I would say almost with every one of these, there's tax implications involved. And I go back to what I said earlier, there are many times when I find out that a client has a purchase agreement already in hand. Usually the reason I find out about it is they reached out to their tax accountant just saying, hey, can you take a quick look at this and let me know if there's any tax issues I should be aware of, which is unfortunate that it went through a letter of intent process and got to the purchase agreement process, and now we're just being asked about taxes when we didn't do all these other things we could have potentially helped them with. But again, one of the number one things that I see derail transactions is usually somewhere along the lines the tax side was deferred until later in the process, and then something came out either during the due diligence or just through questions and planning process to go through the sale. Again, this slide just shows, there's so many different types of structures and types of transactions that are structured as an asset sale, a stock sale. It can get very complicated, and especially if you're dealing with a private equity, family office type buyer, a buyer that might be doing a minority investment versus a complete control investment, maybe an 80% with a 20% rollover with the ownership team or the leadership team staying on. There's so many things that can complicate the tax side of the transaction. Again, this slide again just talking about basically different types of issues that can come up during the process. I really want to kind of jump to the other slide because I know we're getting close to running out of time. But this after-tax cash proceeds, as a business owner is thinking about the sale process and has either an indication of value in their head or a valuation in their head or an offer, I would recommend not doing anything until you do this analysis. This is so important to not only understand what that offer really means from a value standpoint, but what does it mean after you've paid all your taxes? So I've been involved in transactions before where I'd say a less sophisticated investment banker or broker did not understand the tax consequences for their client and had not walked them through it. And once the tax accountant got involved on the seller side, the deal basically derailed because there wasn't enough after-tax cash proceeds for the owner to live the same type of lifestyle and that they were accustomed to, especially once they got with their wealth management firm. So these are things that, this is when your wealth management team needs to get involved, your personal tax accountant needs to get involved and thinking about what does this mean for you, your future generations, for your wealth going forward. So a lot of times, there's other tax issues that come up to clean up state and sales and use taxes and other things. But many times it's just, the business has been run to maximize value for the business under different circumstances than what it's going to be once it's sold. And to understand what's really going to go into your pocket at the end is so important, to then work through that with your wealth advisors and your accountants and your financial planners going forward to make sure it's going to be a good fit before you move forward. Don't find out, 10 days before the sale process is completed that you're not going to have the money that you thought you were going to have. So with that, we can open it up for a couple minutes, maybe of Q&A, but
Yeah.
maybe from a process standpoint, if there is a lot of Q&A, we can kind of send those again to either my LinkedIn profile, or we can try to answer those. It might be a little difficult to do that here with only a couple minutes left to go, but I hope everybody found this presentation enjoyable and educational. And I think we've got a great future of emails and webinars scheduled that will dig into these a lot deeper and help you get a better understanding of some of the risks and opportunities that you can have as you go through planning for a sale process.
Yeah, Brian, we got to give a shout out to Chris for being the first one to pose a question. So maybe I'll throw this one at you real quick.
Okay.
I know that our time is limited here. How important is the need to have reviewed or audited financials prior to a deal being made?
Well, I talked a little bit about that in the seller ready financial presentation. It's nice to have reviewed or audited financials because it demonstrates that the financials should have been prepared in accordance with generally accepted accounting principles. Usually it talks to some level of controls, internal controls over the accounting and the financial statements. So it doesn't have a negative impact on the value at all. But if you're a company that has never done those, again, the quality of earnings is what's going to go through the diligence process and be utilized. It's just a more reassuring to have reviewed financials or audited financials from a buyer perspective, because you know that there's certain controls and generally accepted accounting principles that are in place.
Awesome. I think we've got a couple more minutes here, so I'll throw one more at you. Somebody asked, what are key indicators that the financials are not in good shape?
Well, I think, the first indicator in the due diligence process is when we start to ask questions when we're in the buy side and we don't get timely answers, or when we ask for support for a certain item that is pointed out to us and the CFO or the controller on the other side isn't able to provide good support for our questions. Other things such as account recs not being done, cash not being reconciled on a timely basis. We do simple things like trying to tie out the revenue to bank statements as we go through the process. If that doesn't tie out, that could indicate there's a revenue recognition issue. There's just a number of issues that could come up on the tax side. If the client ships to 50 states and only files one state tax return, that could be an indication. I could go on, but I know we're running out of time, and I think we'll give everybody a couple minutes back so that they can get back to the rest of the day. But again, I want to promote the rest of this series. I hope everybody can attend or participate, read the emails that come out, and continue to prepare for the sale process. When's the best time to plan? Now or yesterday. And it's not too early to plan for an exit process. I would say at least 5 years in advance is a great time to really get started.
Awesome. Well, thanks, Brian. I think that wraps up our questions and presentation for today. To all of our attendees, please remember to complete the survey as you close out of the webinar. If there were any questions that we were not able to get to, we'll be in touch to help answer some of those questions as well. We've got your emails and everything, so Brian will do his best to follow up with everybody personally. As a reminder, more webinars and other valuable resources will be coming out soon to explore today's topic further, so please stay tuned. Again, thank you for attending. Have a great rest of your day. Thanks, everyone.
Thanks, everybody.